My stock started off the week on a really sour note, so we're going to take a look at it and take a look at today's selling in context of the moves that we've already been seeing, and what they mean, how bearish they really are. Are we in a bear market right now? You heard that a lot on TV today. The NASDAQ is officially in bear market territory. Is it really in bear market territory? So we're going to break that down. We're going to talk about, again, why that's significant. Why, we don't want, if we're not, we don't want to think that we are, if there's more downside to come. And if there is, how much more is left to come? So we're going to break all that down today. What's the move in the markets? Some of these other asset classes are showing some pretty parabolic moves, so we're going to take a look at those. And then our trade idea is a stock, excuse me, our trade idea of the day is a stock that is rolling over. That's not as parabolic to the downside as some of these others are. That appears that it might be just starting, and so we'll talk about how to trade that and what its charts look like and why it looks as bearish and why it looks like it might be just starting a bearish trend and how to trade it. So let's go ahead and get started. Today is Monday, March the 7th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see today's big down day. We essentially got back down. Let me get rid of this near-term line. Here's the intermediate decline that we've been on. We've been trying to retrace it a few times. Again, getting up to the 38% retracement this go around, right back down to the below the 23. You notice there's an orange dotted line. That's the 23% retracement of that big long-term COVID move. The S&P is the last one. The Russell is well below its 23. The NASDAQ is also below its 23% retracement, and now the S&P is almost. That's when you start declines, right? You start declines when you break the 23% line. The S&P is just barely starting this long-term correction. It's hardly a bear market, no matter what they say on TV here. It doesn't matter how much we are down from the all-time high. It doesn't matter because, again, how far down from the all-time high we are is a function of how big the rally was to produce the all-time high, which we know was historically huge, right? I mean, you look at the rate of change when we were to go to the 1 year rate of change here. We've had some of the biggest 1 year returns that we've ever had, right? So again, I go back all the way to 1958 on SPX to see how big, like, this 1 year return that we had coming off of the COVID low point, which hit what, 75%. 75%. That's how far up we got up above. Let's see here. I don't know why it's not going all the way back to 1958. Give it a second here. So when you look at, so again, if I were to scroll all the way back, even to again, 2000, coming off the 2009 low point, we didn't even get up to 75%. We got up to 67%. You can see coming off the 2003 bear market low point, we were 40%. Some of these big peaks that we got in the late 90s, some of the biggest 1 year returns we got were close to 50%. Remember, we're at 75% on SPX. You have to go all the way back to the early 80s. Coming off that low point, we had a 1 year return of over 57%. But you can see we've never, ever, since 1958, since it became a 500 stock index, we've never had a return of 75%. So, when we get a pullback, it's going to be a function of that return. Obviously, we still have a 9%. We still haven't even dropped to below zero on a 1 year basis. So how can we be in a bear market if the 1 year returns is still nearly double digits, right? So 9%. You can see on some of these other corrections that we've had in 2020, we had negative 1 year returns. In fourth quarter 2018, we had negative 1 year returns. In 15 and 16, we ended up with negative 1 year returns. 2011, we ended up with negative, barely, but negative 1 year returns. And obviously, that's what a real bear market looks like. That's a bear market. You can see what happened to the 1 year returns. That's a bear market. This is not a bear market, right? No matter what percentage we're down from the all-time high, that doesn't matter. What matters is what the price is doing. and the price has hardly retraced 23% of that post-COVID rally on the S&P 500. Your Nasdaq, you can see, we're having broken the 38% line. So if anything, the Russell is more in a bear market than anything else. It actually does have negative 1-year returns. It is below its 23% retracement level on that long-term line, and is closer. And it's just like the Nasdaq, close to breaking the 38%. And now we're thinking about more of a decline. So yeah, we're in a bearish intermediate decline right now. And yes, we're in a market sentiment pullback with the orange line down, but this is not a bear market, not even close to a bear market. And if we think this is a bear market, if this actually does turn into a bear market like our last two, then heaven help us. Because if we already think that we're experiencing extremes and bearishness, we are not, right? We are the size of the current decline is simply a function of the rally that preceded it. Nothing more than that. And that was such an insane rally to the upside. I mean, look at that. Look at this chart. This is a log scale chart. Does that look like a bear market? Right? Coming off of that low, hardly looks like a bear market at all. It looks like barely a little bit of a pullback. And that's it. When that's pretty much what it is right now. If you take a look at some of these other indexes, of course, the Nasdaq, we are, well below 7% below 30-day moving average. Intermediate line, market sentiment line are in bearish territory. Very bearish short-term sentiment. Looking like we're headed towards a new near-term low point. The Russell 2000, same thing. Back to dark pink shading in a red line again. The intermediate line's back down below 50. Bearish short-term sentiment. So yeah, we are in an intermediate decline still. Market sentiment still in bearish territory. We're still in this bearish decline. We are in a correction mode, more on the Russell than anything, but it's just barely starting on the S&P and the Nasdaq for that matter. Let's take a look at some of these other charts. Let's take a look at this weekly chart, the crossover chart. You can see we still haven't got the 10-week moving average across below the 40-week. Again, if you want to see what a real bear market looks like, this is a real bear market. Look at all that. Look how long we had pink shading, which is what happens when you get the crossover. Look how long we had pink shading there. Look how long we had pink shading here. Go weekly chart. On this bear market, I mean, that's a bear market. That's a bear market. Look over here now. Not a bear market. And even if you were to say, well, is the Nasdaq that they're saying is a bear market? Bear market, bear market, not a bear market. Not even close to a bear market. It doesn't matter what percentage down that we are right now. Now we do have a crossover. We're at the beginnings of one, but we haven't broken that 38% retracement level yet. And you can see the Russell, we've had dark, like we are in a correction here. We've had a crossover the 10-week. We've been below the 10-week. It's falling. The PPO is down to some of its lowest levels that we've seen in a while. Now, it got lower in the COVID. It got lower in the fourth quarter of 18. It got lower in 15 and 16. And it got lower in 11. So you can see, it's hardly that we are extremely bearish on the Russell. And again, you're looking at the Nasdaq, which also is negative. But if you follow my line across, we got a little bit lower in the fourth quarter of 18, about this low in 15 and 16, and then not even this low in 11. But again, the Nasdaq, which is really dominated by these mega cap tech names, they've held up really, really well. It appears now that those mega cap tech names are not coming to the rescue like they've had all these other corrections that we've had in the market. And I think that's what will make this PPO end up being a lot more negative than what we have seen, for the Nasdaq at least, in previous corrections. Let's take a look at the 3 green arrow chart. You can see we have 3 red arrows across the board again. All 3 charts have 3 red arrows across the board, so we're light pink shading all the way over. When you look at the 2-line version, again, see, we're just barely, the 50-day hasn't crossed below the 200. How can you be in a bear market when your 50-day hasn't even crossed the 200 yet? But we are crossing below this 23. You see, we're breaking below the 1-year value area, and that we did that previously on IWM, and we've been bearish ever since, right? It really broke down when it broke down below that 1-year value area in IWM. It's doing that now on the S&P, and it's doing it on the Qs. So again, if we break this layer of support, the shelf of volume at that 38% retracement level, then there's not very much support down below. So again, if we're not in the bear market, like if things are gonna get bearish, it's gonna get a lot more bearish. And still, even then, if you think, oh, you know what, he's just doom and gloom. No, like we can fall all the way down to 258. There'd be some serious long-term support there. That's the Fibonacci retracement zone. That's well above the pre-COVID high. It's well above that early 2018 high when the markets went really parabolic and we started this period of volatility that ultimately culminated with the, remember we had the rate cuts in 2019 and then it culminated with the COVID drop, right? The world was in a bear market. The actual bear market, the world was, but we didn't see it because of the Qs. The mega caps really held up, but there was still more volatility there. So look how far up above. If we hit 258, we'd still be way up above that 2018 peak. So again, like we are just kind of getting started here. We're not necessarily breaking hard down to the downside right now, and we could still come down a lot and still be really just retracing what has been an extremely bullish move to the upside, fueled by what we all know it's been fueled by over the last couple of years. When you take a look at some of these other oscillators, especially the trend strength indicators, you can see we are not even to a mature bearish trend yet. Like this has to get below -5 and it has to get above 80. We're not there yet on SPY. We are not there yet. I believe actually we are there on the Qs. We have been, and we never did actually end. So it's been on this bearish trend this whole time. IWM, you can see it has not even started a new one yet. We've been so sideways that it hasn't started a new bearish leg lower. We're actually pretty darn close to the cloud for IWM, but breaking back down, and you can see there'd be some pretty significant support at 188 that if we broke, then we'd probably head down to the 61% retracement level. Let's take a look at some of these other indicators. The directional movement index above 30, well below, but not to an extreme. You can see when the positive gets below 10, that's when we've really hit an extreme low, especially on the weekly chart. That's something I look for to kind of signal that we are done with the selling, is when we get way down here into the low double digits, if not below 10. And you can see for SPY we're not there, for the Qs we're not there, for IWM we're not there. We're low, but we're not below that level yet that would suggest that we're so extreme to the downside that now we're going to come off of that. Not even close. But we are, obviously in bearish levels there. We're in bearish levels there with a really high ADX. It's rising. And we're at bearish levels there with the ADX starting to rise again, up above 25. Finally, take a look at the Bollinger Bands. So let's take a look at the bands with the Keltner channels. We've already seen that we're breaking below the 1 year value area. Let's take a look at the Keltner channels here. And then we'll take a look at the whole in just a second. So SPY, you can see, is back into the lower quartile, getting some bearish momentum down there with a green dot, which means the bands are outside of the Keltners. When you look at the Qs, we also have a new green dot. Again, the bands breaking outside of the Keltner channels. You can also see that today's close got outside the Keltner channel for the first time. And then looking at IWM, we are not. We still are waiting for a new breakout to occur because the bands came inside the Keltners and haven't broken out yet. If you take a look at that whole moving average, you can see we got a new bearish pattern. The whole is turned over, the 20-day whole, but we haven't moved those parabolic SARs up to the upside yet. On SPY, you can see we haven't done that yet. We haven't moved these up to the upside. And then look at the Qs, and you can see still, as bearish as we were today, we still haven't moved those parabolic SARs up to the upside. So, this is a volatile move, but we had a lot of room to trade in and still kind of not necessarily be pushing down. So I wouldn't be surprised if we didn't bounce back up tomorrow relatively sharply, coming off of these pretty significant lows. I wouldn't be surprised if we got a 2% plus gain tomorrow to offset that. And then this gets, but that won't mean that we're done selling either. It'll just mean that we're still in this mode of getting these parabolic SARs to move up. And then as they do, then eventually we'll get the bearish crossover where we get the new leg lower to the downside. But I don't think necessarily this is it. I just think that that the parabolic star was so low that we had a lot of room to be bearish because we got that bearish candle on Friday. We had a lot of room to be bearish, but not necessarily starting a new leg lower, just being very volatile and filling in a lot of open space, and then setting up like I said, for a bounce back up. Again, I wouldn't be surprised if it was a 2% gain or more tomorrow, or Wednesday, right? If we end up with a smaller loss or gain tomorrow, but either tomorrow or Wednesday, really, really soon. When you look at the volume, the range for today, you can see obviously a lower high and a lower low below last week's low point. There's that 23% retracement of this near-term line. Looks like we're trying to get back down in. You can see the same thing for the Qs. We actually have broken below that 23%, but way lower low, well below last week's low point, and IWM too. Again, look for it to come right back up to last week's low, and trade around probably in this area, right back up to about 200, 198 on IWM, and the equivalent levels on all the other indexes. Today's volume was obviously pretty strong. The range was really strong, well above average. The volume was a little bit above average at 137 points. So when you put those numbers in context, pretty strong range, getting us up to 2.25% now, and the volume is relatively high. When you look at it here, when you look at the volatility, interestingly enough, volatility still has not spiked yet. So I mean, we're at 36. We're at 36 on the VIX. We're at 36. Last time we were here, the VIX was up to 105%. Over here, we were at 36, and the VIX was again up at 105%. We're barely above 100%, which means that the market is still concerned about this being more than just a quick pullback. That it's actually going to be more of an extended decline, which would be the definition of a correction, right? Where we start to fill in the gap. And again, I've shared with you this before, but my definition of a correction is any move that fills in this gap between the 50 and 200 week moving averages. My definition of a bear market, again, the last time we've actually had one, is when we fail. So every bear market starts with a pullback to the moving averages, and we had a couple here, and we bounced back up, but then we started to fill in the gap between the 50 and 200. That's a correction. We bounced back up, we failed, and then we broke below the 200 week, and that is a bear market. This is the beginnings of a bear market, and of course that's the big fall off the cliff mode, but that's a bear market. This is a correction. This is a pullback. These are pullbacks, two pullbacks. This is a correction. This is a bear market. So when you look at that perspective, you can see up here we are just barely below the 50. We are just, this is still, because we haven't broken that 23% retracement line yet. This is still just a really deep pullback on the verge of the beginnings of a correction that has actually started on IWM. As you can see, we've filled in a big chunk of that gap now, and it's already started on the Qs, right? The Qs, we are well below the 50. The 8 and the 17 week are below the 50. We are in correction mode. We are below that 23% retracement. So we are correcting on IWM. We are correcting on the Qs now, and we are not quite started yet on SPY. It's just barely starting, and like I said, we are on the verge of actually transitioning from a deep pullback to the beginnings of a correction. And again, it doesn't start a bear market until price and these moving averages get below that dotted blue line. So no bear market at all. And again, you can see the market's concerned about an extended decline that will last a while, because that's why the VIX 3M is not very high. And when you look at the skew ratio, which measures how in demand those deep out of the money puts are, it's still, even with today's, it's still very high, up in the 136. Usually when we have really sold off, you can see even on a normal intermediate decline, you can see the skew drops way down below 120, 115. If I were to go back out to some other levels here, Like in 2018, fourth quarter 2018, you skew way dropped below 120. You go back out to 15 and 16, you can see it dropped significantly because the market was done. We had dropped. The market was no longer worried about deep drops from those lows. But if this is the low, the market is still concerned about an extended drop, and with the VIX 3M so high, it's still concerned about an extended drop, a time frame where we will stay down for a while, because this is hardly spiked. Again, when this gets to 125%, 125, that's when we know that we have hit the bulk of the selling. That we might hit a new lower low eventually, but the bulk of the momentum to the downside is done. And look, we're not even 105. Like, again, to be at 36 and to be that low compared to these other instances that were just a few weeks ago shows the market is hardly like in an irrationally fearful bearish mode right now. We can still be a lot more irrational if the VIX gets a lot higher than this. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know why either you're a lot more bearish than what I've been showing you, or you might be like, this is the best dip that we can buy in ages. Let's buy it now. Right? So you're a lot more bullish than I am right now. What charts or indicators are you looking at that tell you that? And share those with us in the comment section down below. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, of course, number one. And number two, it tells us that you want us to do another video again tomorrow. It's a quick way to give us feedback and let us know that you like our stuff. You want us to keep doing it. Of course, if you don't have to click anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What stood out to you today? What questions or comments do you have about anything that I brought up? Or, like I said, anything that stood out to you? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. I put some stuff out there today for an example, so you want to check that out. Also, join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon that takes you to our Market Outlook live page. This is where I review all the Market Outlook trades that we've done in prior videos, the ones that we're still in. We talk about whether we should stay in them or get out of them and why and how to manage them. We talk about that here. We also put on today's trade idea that you'll hear at the end of the video. We already put it on today before the market closed. So we did that in this too. So this is where you watch it. You can see all the old archives here. You can also get to it by clicking on Market Outlook Live Trade Review. Also, you see our upcoming classes. Click on View More. That takes you to our trading rooms calendar. You can see all of our upcoming classes for the rest of the month. We have 4 years worth of recordings now listed here since we started 4 years ago in March. So we have 4 years of recordings there you can check out. Come down here, click on that heart. It opens up this tab. Hit that like button. Also do the same thing for the Facebook. Click on that thumbs up. It opens up this tab. Hit that like button too. Again, the more you do that, it helps our content get out to more of our followers because of how their algorithms work. The more engagements there are, the more people the more reach the post has. That's why we always ask you to like them. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here on our website. All right, now let's take a look at what's driving the price action. You can see across these different asset classes, gold is spiking up, the dollar is spiking up, bonds are not spiking up, interestingly enough. So you got your safe haven areas here, but bonds are not rallying higher. In fact, you have dark pink shading. But global equities falling hard, emerging or developed markets getting a cluster, emerging markets getting a cluster. They're getting hit the hardest right now. You can see U.S. equities are just down a little bit, so there's probably a little bit better margin of safety now on these international areas. Silver, look at copper, look at that big engulfing pattern outside day on copper there. You'd expect that to be a reversal pattern to come down. Silver is kind of rallying up with gold. Crude oil rallying up, but that's a pretty significant doji, big time range with a very small body suggests that the rally might be kind of close to an end, at least the parabolic rally. We might start to flatten out a little. We might not necessarily drop sharply, but we might start to flatten out. You can see Bitcoin, so much for Bitcoin being a safe haven, right? That was always being brought up as a safe haven opportunity. Well, it's been in a death cross environment, and we've retested 200 now multiple times and failed both times, and now we're back below its 30-day moving average. The 8 days, the MACD is negative. The 8 days back below its 17-day. And they look like they're headed back below the 30 as well. The Bitcoin is below its 1-year value area, so it's back to being negative. And you can see it's close to, it also hit that resistance at the 38% retracement of this move. Whoops, of this move here, of this rally off the COVID low, right? So it hit that resistance. Now it's rolling back down towards 29,000, if not eventually down towards 18,000, because there's just no volume down here. Once it does break, there'll be a little bit of support there, just under 30,000 at the Fibonacci retracement levels. So, but again, you look at it's the long-term, correction, pullback, that kind of nature. We are below the 50-week moving average. We have been. Now the 8 and 17 are below it, and the 30-day looks like it's about to cross. We are in correction mode on this, and it's very likely now that we'll probably head towards, at least 29,000, but probably through that because there's no volume there. So we probably easily come down towards 18,000, and of course getting below that. And again, you can see ARK Investments is doing the same thing, right? ARK Investments has already broken below. It looks like it's starting a bear market, right? It is below its 200-week moving average. It's below, in this case, the 5-year value area. It's breaking below the 78% retracement level, so that you can see there's nothing here. So it's going to be really easy for it to fall back down towards $33. That would be a bear market for ARK, an actual bear market. No matter what the number is of this decline from 160, getting below the 200-week and staying below it long enough to get these moving averages to come down is what a real bear market is, and that appears to be what's happening. And get rid of these now on ARK Investments. That is what you would expect to see when and if the broader markets themselves start their own bear markets. But like I said, we are so far away from that being the case. Let's look at long-term bonds. So long-term bonds have been again kind of up and down, lots of volatility over the past week. You can see they have been really bearish. They hit the support at this Fibonacci retracement level. Let me show you where that comes from. So that big long Fibonacci retracement. I'm gonna have to go back to 5 years on this. It goes back to that 2018 low point all the way up to the post-COVID peak. We hit that retracement, that support level right there on the retracement. We started to get back up above these moving averages. We essentially filled in the gap between the 30 and the 50, and that's really all we're doing. But we are still above the 17-week, or 17-day, excuse me. The MACD is rising. It's now positive. It's gone through, it's gone above zero now. So, looks like that bonds may be starting to follow where everything else has gone, right? Gold is gone up to a new trend. It's broken above that 23% retracement. It's really gone parabolic right now. In fact, gold and the dollar have gone way parabolic. You can see its negative index is way down below 10. And the positive is well up above 55 now. That's a parabolic move. That's hard to sustain, and I think we're very, very close to the end of this rally in gold. Of this rally, right? I think we're going to trend higher now for a while, but I think the rally in gold is up. I think the dollar's peak, like we're hitting this 78% retracement level. I think this is about where the dollar will end up peaking here. I think this is where it ends up peaking, because you can see it also has gone parabolic with the positive index up to almost 50 and the negative below 15. And again, the last time we were even close to that, and also hitting an important Fibonacci level, was also the end of the bullish move that it had. If you look at the euro US dollars, another way of looking at the dollar against the euro, the euro has been really declining. In fact, if I were to go back to this peak in the euro from, let's say since the beginning of the month, let's go to the currencies chart, comparison chart, and then let's go out to the beginning of the month. This is one of the reasons why the dollar is so bullish. So we'll go out to February like the 4th, I think is what it said. We'll go out to like an hour, 30 minutes. The euro, there's your Swedish krona down 10%, but the euro is down by far more than everything else. The dollar's up against most things except for the Kiwi and the Aussie, because they're very commodities related, so they benefit from the strong commodity prices. Canadian dollar's not down very much either, but you can see the British pound's down here, down 3%. The Swiss franc is flat. The yen is flat. So they're just barely below the dollar. Those are safe haven areas. And then the euro down 5%. That's a significant move in the euro against everything, not just the dollar, but against everything. So I expect that the euro is gone parabolic itself, and will start to reverse some of that bearishness that it has. You can see the getting up almost up to 40, getting well below 10. I think that this is kind of a parabolic move, especially with these clusters we're getting, that we'll start to see it make a run back to the upside and put pressure on the dollar, which will still lift. I mean, imagine how strong commodity prices have been with the dollar rallying as much as it is. What if the dollar wasn't rallying and it was the euro that was rallying? I think eventually we're going to get that scenario where the dollar starts to roll over and gold and commodities continue to stay strong, which will put a lot of pressure on U.S. equities with these higher prices, these commodity prices, these input prices, which will just raise prices on everything all the way through the system. Let's take a look at how the major economies are doing out there, and kind of have to take one of them off because RSX stopped trading. Let's go to the 12 grid. So RSX stopped trading there, so we can't really look at that now. I guess there's a little bit of a move there, but everything you can see, look at all the dark pink shading and red lines, and look at all the big drops below. The only thing that really is relatively strong is Brazil, because it had a better margin of safety than everything else. So it's actually doing really well. And in Canada, you can see it's relatively sideways because of its link to commodity prices. It's holding up very, very well. When you look at the secondary, so this is the first 12 biggest economies. If you look at the next 11 strongest economies that are out there, keeping the S&P 500 up here, so this would be the next 11. You can see Australia is also holding up pretty well. Saudi Arabia holding up pretty well. Argentina, pulling back but holding up pretty well. Everything else, Switzerland, Taiwan, Sweden. You can see Mexico even finally breaking down today. Spain is down. Netherlands are down. All these European, lots of dark pink shading. Unless you have some link to commodities, you are getting hammered right now. Let's take a look at the sector moves now. The U.S. large cap sectors in particular. Let's look at their 12 grid first. Again, you can see the cyclical names up here at the top, all rolling over. You can see some of these other cyclical here in the middle, materials, industrials, financials are getting hammered today, but energy holding up well, utilities holding up really well, and so we kind of know why. Safe haven, and then commodities here, and materials to a degree, commodities, so not down as much as some of these others are. And then healthcare is actually holding up relatively well, and then the other safety trade staples holding up pretty well too. So when you look at how they performed here today alone with their comparison chart, look at that move, 36% move in energy. Now remember, you have to remember that energy was a big loser, right? And so it's gaining now, but it had been a tremendous loser to the downside. I mean, look at that, like coming off the 5-year chart, coming into COVID, it was down a lot. And everything else was actually well up off of that same starting point. We're well positive, and energy was, so energy is still lagging on a 5-year basis. Some of these tremendous returns to the upside. So again, that's the reason why it's doing so well. So take that strength there that we're seeing with a little bit of a grain of salt there, because that's why it's doing so well. It was down so much. When you look at just today alone, so we'll go to March 7th and look at just how things performed today. There's your energy and utilities doing very well, 1.5%. Discretionary down 5%. Technology, financials, materials, I mean, every cyclical area down sharply. Industrials down too, and it's just really safety. Safety is the only thing holding up. I mean, they're down too, but not down nearly as much. And in the case of utilities, holding up. In the case of energy, because it had been such a big loser, it doesn't have as much to lose anymore. I mean, just to kind of give you an idea of how energy has been performing relative to the S&P 500 for however many years. It looks great here on this chart. Let's on the 1-year chart. Let's go back to a 20-year and let's look at a weekly chart here. And then we'll keep that at a 1040 cross. So you can see, look how much energy has been declining. So we're just getting above the 200-week moving average on a relative strength. It's just starting a new bullish. I mean, the MACD is positive. The PPO is finally positive here, up to 17% on the PPO. Look at the CCI strong. Look at the ADX EMI on the weekly charts, the highest we've seen in a long time. The RSI, I mean, this is a good, strong move. Eventually, it's going to retrace some of this, but it appears to me that the trend, this big bearish trend that we've essentially had since the credit downgrade, right? Energy has been a big underperformer for a long, long time. It appears that that trend is finally reversed and will start to move to the upside. I mean, to show you what it looks like on this chart, let's go here on this chart and let's look at XLE, but we'll look at it relative to SPY there and then SPY on this chart too. So again, you can see how significantly low the relative strength line was. Down here below its moving average, finally up above it. It's finally turning up, but see how the room it's got to go up. Like, it's at all-time highs on an absolute basis, but it's not at all-time. I mean, look at 2014. Look at where the relative strength was compared to where we are. We're still half of that level. So we're hitting all-time highs in absolute. We're still half of where we were on a relative to the rest of the market, and you can see the relative strength finally getting to high levels coming off of these really, really low levels that we had seen on the COVID. So eventually we're going to lose some momentum. It's going to roll over, but I think the trend is intact now. The energy will be a big performer, an outperformer on a relative basis now going forward, like it was in 2007, 2008, till it finally peaked and the end of that commodity cycle ended, and then the bear market started on a global basis there. All right, so for our trade idea of the day, I want to take a look at UPS. UPS is really kind of rolling over. It's been holding up pretty well relative to the rest of the market. It's been pretty sideways, but of course, commodity prices rising and oil prices rising won't necessarily help a company like this. Its market sentiment line is declining, but it's been sideways in neutral zone. The intermediate line has been also kind of stalled at the lower end of the neutral zone, but it appears that we're a little bit more bearish now. This is a pretty bearish near-term peak in bullish territory, but not up above 90, not extended stay. Like, it's a pretty bearish near-term peak. Obviously, a much lower high point compared to the last near-term peak that we had. You would expect a lower low to come out of this. That's my expectation. That's why we're looking at a bearish trade on it. If you look at its long-term chart here, you can see we got a red arrow so we're back below the 10-week. We have a negative differential, so a bearish candle, a red arrow on the 10-week, and a falling PPO, so a bearish chart from that perspective. When you look at the MACD and stochastic indicators, we held resistance at the 1-year point of control. We broke the 200-day moving average. The MACD is negative and it's coming back down now, and it looks like a new leg lower to the downside. The stochastics is peaking and rolling to the downside. When you look at the directional movement index, we're getting a break up above 30 on the negative, and it looks like we're going to get below 20 on the positive index. Looking at the RSI and the CCI, they are breaking into bearish territory below 40, below that minus 100 level. When you look at the Ichimoku cloud, we are below the cloud, even though it's a very skinny cloud. We're below the cloud. We're starting a weak bearish trend as it stands right now. It's Bollinger Bands. We are in the lower quartile. We broke into the lowest. We had been in the middle half. Now we're in the outer half. In this case, the lowest quartile, and we're really pushing down to the downside. So what I decided to do on this was to come to its options and buy the at the money for April expiration. Buy the at the money put, so the one with the most extrinsic value, and then sell one strike away to reduce the cost. So what it ends up looking like is this. So we'll go to single symbol. So we got, for normal position sizing, we need to get down below this 195 level to get our full return. Knowing that, if we were to break up above these moving averages on UPS, and let's go back to the day, and you can see it looks like we're just starting to break below the 50-week and start a correction, which would be really bearish for this. But if we are indeed starting to break down here, and start a little bit of a bearish move, again, it only has to get below 195, which is right here, and then stay below 195. And if it does that, then if it bounces back up to 212, 212 and a half, 215 in that area, then we'll get out with half a loss of what we're positioned to lose, about $500. But we can, get a $1,500 reward if it works out for that risk. So really good reward for a small risk for a pretty directional trade for a stock that looks like it might be shifting more towards the downside right now. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open a new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below, like us on Twitter and Facebook as well. Join our website at marketscholars.com. Have a great rest of your Monday night, everybody, and we'll see you all next time.